Hello traders, welcome to the LFB and our global video charting review. This is for February the 14th, 2011. My name's Marco Haig from the LFB Trade Desk. All content and information and data that you're seeing here is provided courtesy of the automated trading program, which is available via Tradency and FX CM. We do have to point out that currency trading does involve substantial risk, is not suitable for everybody, and each investor should take independent advice before doing anything with any form of investment. Disclaimers are posted to the website, and we do ask that you read through and accept those disclaimers before taking information from the videos. Divergence signals are coming from the dollar. Currency markets begin the week in very mixed fashion. We're looking at the dollar index on this chart with strong divergence between the major pairs as the market fumbles generally to find fair value on regional currency exposure. There's a lot going on regionally now. For example, the euro, which makes up nearly 60% of the dollar index, has lost ground to the greenback, in line with moves lower in West Texas intermediate oil trade, while at the same time the Canadian dollar grows stronger. The British pound becomes a little weaker and the other major currencies consolidate. The divergence seen between major currencies in their movement against the dollar has also been seen in the divergence from the inverse equity US dollar pattern in the near term, where equity markets over the course of a 12-month period would go higher and conversely the dollar would go lower and vice versa. That's now getting tested. The reasons can be laid squarely in the lap of the Federal Reserve and their successful attempts to push primary dealers out of Treasury holdings and into equity trade. The low participation ramps higher in global equity markets are not transposing themselves into long positions in the major currencies that historically have 90 to 95% correlations with those equity market movements, which in turn creates the historical inverse equity dollar correlation that's currently breaking down. The signal from the market is whatever manipulation happens with equities, that it will not be easily transposed into moves into the currency market. The coming week is heavily laden with red flag economic releases that will very likely draw attention back to regional growth stories, and it may be a period of trade that currencies dominate, especially the dollar index domination, rather than follow, which they normally do, the interest rate and equity leads. The dollar index continues to hold around this triple bottom area, around this 78, 78.50, that over the course of the last 4 months has led to upside tests of 82. It would seem that traders will witness a replication of the 2009-2010 quantitative easing trading patterns, where the Fed's open market operations led to all asset classes being floated at the same time, including the risk and safety markets. So, in other words, equities up, commodities up, and the dollar up in that near term. Very unusual that that would happen, but it is what we're seeing. In any given 12-month period of trade, there are usually 6 months of trend, 3 months of consolidation where existing positions are held and protected, and 3 months of distribution where existing positions are carefully liquidated. And these periods of trade where you have in a year 6 months of holding a relatively strong direction one way or the other, 3 months of consolidation where existing positions are held and protected from any tests of selling, and also then 3 months of distribution where existing positions are carefully liquidated as that trend changes. Unfortunately, the trading environment and arena that has been created by the Federal Reserve has allowed those 3 cycles of trade that you would see over a 12-month period to now be completed not in months but in days and weeks. And that's what's creating this unknown effect from quantitative easing, not necessarily what we're dealing with now, but trying to value what's going to happen when quantitative easing finishes. That's not our job as traders. Traders are reactive to market conditions. It will be the major institutions that then are charged with getting the valuation in line with what then are current economic outlooks. Euro continues to look weak against the dollar, but traders will be very much aware that gravity will not pull euro lower for too much longer if global equities continue to ramp higher. The Swiss franc and Japanese yen, which are linked to global interest rate markets, are confirming that the major moves that break and subsequently hold 2010 price points on this dollar index are going to be difficult to complete in the near term. There is resistance against movement on the dollar both ways at this point in time. Low liquidity, a high cost of carry, and higher interest rates in the face of quantitative easing programs from the Fed have transpired to create another black swan event that's playing out early in 2011. Most major currencies are back to their opening prices in Monday trade, having tested both support and resistance against the dollar during the Asian and European sessions. This may be the calm before a very heavy storm that unfolds as this week's red flag economic releases hit the newswire and subsequently impact currency valuations. Bank early, bank often, and look to buy support and sell resistance at the previous session high or low, which will keep most traders in line with the current market outlook. Thank you very much for making the LFB and our automated trading program a part of your day, and thank you to the LFB trade team for making this data available to us. You can subscribe to our daily newsletter if you want to get this information in your email box as soon as it's delivered. You can also follow us on Twitter. The newsletter you can get from the LFB website, www.thelfb.com, and you can follow us on Twitter, twitter/the LFB.